Hello, thank you all for joining us this morning. We are here today to talk about private debt, and I'm joined by Frédéric, Nadal, M.Kebbel, and Declan Hudson. Let's start by a brief introduction of each panelist to understand the company they represent, the type of business they follow, and their duties within the company. Frédéric, do you want to start?
Yes, good morning, and thank you very much to all of you for attending. Can't see you, unfortunately. Hopefully next year I'll be able to be in Munich. In the meantime, thank you very much for the opportunity. And I co-founded the company, and I'm currently the CEO of MV Credit. We founded this company 21 years ago already. So we've been through a few cycles and a few big events, including the internet bubble in 2001. So that's an interesting one to relate to. Our firm started with, as we used to call it, mezzanine funds, and very much so we're still in the space of subordinated debt. But since then, we got into bank loan funds, CLOs, and more recently in liquid credit. So we've been through a lot over 21 years. And as I will probably say again and again and again, is to, I believe credit is not about being the smartest guy in the room, it's about experience. We're not here to launch rockets on the moon or on Mars. But we're here for experience. And I think having been through September 11, internet bubble, Great Recession, COVID now, and probably post-COVID, what's going to happen next are absolutely key to be a good credit investor. I leave it to you, Gerald.
Thank you, Frédéric. Michael, do you want to introduce yourself?
Yes, for sure. So hello also from my side. So my name is M.Kebbel. I'm a senior portfolio manager at Ampega Asset Management, which is the asset management unit of Talanx Insurance Group, which is the third largest insurance group in Germany. We are currently responsible for approximately 150 billion euro equivalent. I'm part of the fixed income division. And so I think also we have a quite long track record in investing in, let's say, alternative credit. So we started investing in high yield bonds in the early 90s, followed by investing in the CLO space in the late 90s. And so we opened up our budgets also for private debt in the 2013-14 timeframe. So quite a long experience here as well. Again, so I'm talking here on behalf of the fixed income division, which is responsible for cash flow direct lending in the corporate space.
Thank you, Michael. Declan, the floor is yours.
Okay, thank you. Hi, everybody. I'm calling you from very stormy weather in London here today. I work at MJ Hudson. MJ Hudson is a dedicated private markets consultants. We have around about 100 billion sterling of assets under advisory. Our client base are public plans on the DB side, notably in the UK, but elsewhere in Europe also. We also advise family offices, and increasingly we are advising foundations also. We have a growing team of around 200 people in this business, and we've got a very exciting business in ESG, where we follow the Dutch rules for ESG. And when I say it's the Dutch rules, and we'll talk about that a little bit later, it's really focused on the pragmatic advancement of best practice ESG for LPs and GPs. Over to you, Gerald.
Thank you, Declan. So to conclude this introduction, I'm Gerald Gonzalez. I work for Natixis Investment Managers, which is the largest asset manager with above $1 trillion of assets under management. We follow a multi-affiliate model, and NV Credit is one of our affiliates expert in private debts. I'm part of the investment specialist group, and I work closely with all alternative affiliates, and I'm based in London. So now that we have introduced everybody, let's start with the private debt corporate space. It's a popular asset class nowadays, and it's composed of several substyles that coexist, where a lot of names like direct lending strategies, unitranche, senior, subordinated debt. So Frédéric, as an expert of this space, could you please share with us the way you see this world and how MV is positioned?
Yeah, it's a good question. It's utterly not complex, but there's a lot of there's many segments basically in this space, and I won't give you a 1-hour discussion on our industry as a whole. All I can say is basically what has been extremely popular recently are all what we call direct lending. We hear a lot, and it's basically when we started 20 years ago, we set up MV. There was basically the banks lending money, and a couple of very few subordinated funds. That's it for the LBO market. Since then, I mean, we've seen the emergence of the first CLO business. What we call institutional money. In Europe was probably the first CLO was probably in the year 2000 as well. And it's been a huge and exponential growth. The interesting thing is that in the year 2006, we saw the huge trend in getting money into CLO and subordinated debt. A lot of people wanted to do CLO and subordinated debt the same way we see a lot of investors for the last, I would say, 8 years doing so-called direct lending. Why direct lending? Which is another segment which can do LBOs and non-LBO lending, disintermediating banks, basically. Banks with what happened in 2009, the theory is that they retrenched and lend less. Hence, the need for private lenders to get into that industry and lend money directly to companies. When there is a financial sponsor, it's called an LBO, and when there's none, when it's not called an LBO. So we've seen that is the major thing that happened to our market, which is the emergence of the direct lending business. But itself, there is within the direct lending space, there's many under sub-segments. When you do 400 or 500 million unit tranche deal that few people can do, international firms can do, or when you lend to family business that generates 5 million euros EBITDA, again, there's a very wide gap, and it's not exactly the same. So the overall point is that there are many segments in this business, in the private debt industry. They're all good in itself. There's always a need for all those different segments. The thing is, sometimes there's an element of fashion which makes certain segments, such as the direct lending one at the moment, very hot, which means a lot of cash has been poured by investors into this specific segment, which show a dramatic decrease in pricing. I mean, people were marketing direct lending funds just 2000, I would say 2010, 2012, at above 10% net returns. Nowadays, they are generating around 5, 6, 7% return. So we've seen a dramatic increase driven by this amount of cash. The other thing, and the latest trend I could see in this industry, in the private debt industry, is obviously the emergence of distressed debt. Obviously, due to COVID, there's some more money that has been allocated to distressed debt, which basically is a topical allocation, I would say, and in the sense that a lot of people were expecting a lot of defaults that haven't materialized yet to a certain extent. So I'm sorry, it's a very difficult exercise to give you an overview of such a diverse and industry with so many segments, but I've tried in less than 5 minutes to give you that. I'm sure my Declan and Michael will be will give us their view on that.
Thank you. You have done a very good job, Michael. Looking at private debt through the insurance angle, how do you approach private debt in your allocations? What are the characteristics that you're looking for in this strategy?
I mean, first of all, it's always depending who you are talking to in a 150 billion euro AUM organization. So I in particular will talk about the allocations to private debt that are in the hands of the fixed income division. So there is other parts in the group calling it infrastructure, calling it private equity, mezzanine investment. So these people have different approaches. So when I'm talking about corporate direct lending in the fixed income space, so then we are talking about cash flow lending in general. And what we felt most attracted by is the senior and unitranche segment. I mean, Frédéric was already talking about yield expectations, and I mean, getting 5, 6, 7% net returns on an asset class is quite attractive to yields in the corporate credit space for investment grade bonds, which are probably more in the 1 to 1.5% arena. So that's obviously the reason why people having a look at the asset class. When it comes to vehicles, our main preference is investing by closed-end funds and also by middle market CLOs. Obviously, this is the latter one is a topic which is only existent for the US side of the market. However, we will see if this is not also something that will come up in Europe at one point in time. So what's the big advantages? What are the drivers behind allocating in the asset class? I think from my perspective, it's basically 3 things. So investors can earn a current income on their investment from day one. The second thing is you are facing limited mark-to-market volatility. So, I mean, the recent COVID experience has shown that. So what we generally observed is a up to 20% percentage points price decline in broadly syndicated loans, while the direct lending side of things were more dealing with price declines of around 5 percentage points. And the final argument why people should have a look at the asset class is we are not facing something like a J curve in that space, given that on senior strategies the general rule is that the investment management fees will be charged on invested, not on committed, and in combination with getting an income stream from day one. So you do not have to deal with any J curve dynamics here. So yeah. So anything that I did miss here from my side, Declan? Have you any more thoughts on that?
Well, yes. So I think the supply and demand drivers have been very well explained by Michael and Frédéric. One thing I would add, some of the academic literature on the harvesting of illiquidity premium that started in the early 2000s, where there was a review of portfolios, investment theses across pension plans, and there was a broad conclusion is that they, from time to time, are over liquid compared to their liabilities. So those pension plans would benefit from increasing allocation and harvesting this illiquidity premium, and that lended itself to an allocation into private debt space. The main reasons, just to summarize, are capital preservation and return maximization for the risk profile that you're taking for investing in private debt. So we have seen increased allocations for folk, sponsored direct lending, is more focused on the capital preservation. In terms of return maximization, we've seen more niche strategies. Frédéric mentioned the advent of distressed or credit opportunities. That's interesting, but also other niche strategies such as transportation assets, lending for leasing contracts, etc. All those niche strategies have become very, very interesting to our investors. And again, that seeks to, for the risk one's taking, to increase returns. Things that keep us up at night are generally a mismatch, obviously, between demand and supply. And how that manifests itself for investors is that potentially spreads are reduced. So that's an issue. And obviously the big one we're very aware of and very focused on is, the advent of covenant light lending contracts. So again, when we look at that, we look at experience of managers, as Frédéric said. Generally, the longer you've been in this asset class managing money, and our conclusion is that you have seen many different shocks and you've seen covenant light investments before, so you're attuned to the risk they're in. And that's lent itself to other lending strategies when spreads come down, for the convenience sake, for looking at unitranche, etc., as a way potentially to do a vertical lending strip when lending to corporates, etc. So that's another thing. So that's a quick tour of what we see in the asset class, but there has been a fundamental shift in this asset class that has developed over the last, call it 5 to 10 years. And basically, it's been a huge increase in allocation. Typically, Michael sits in the fixed income team. Typically, we've seen a reduction in fixed income to afford an allocation into private debt, although many folks still place this in their alternative portfolio, and that alternative portfolio is a smaller allocation to this asset class. I'll pass back to Gerald on that point.
Gerald, you're on mute.
Sorry, as you said, Frédéric, it happens once a day. It's my time today. Sorry about that. So in private debt, we see recently a lot of news on the healthcare and IT subscription services. It seems that it's very trendy at the moment. From where you sit, Frédéric, do you see that as a trend?
I mean, the thing is that as a traditional credit manager, your first goal is to avoid losses. As Declan said, for the traditional credit manager, it's not about maximizing return; it's about minimizing losses. It's mathematical. When you're in private equity and you're meant to be generating multiples of your investments, losing money is not such a big deal. It happens. In credit is a slightly different ballgame. You're getting a yield, and therefore losing money is something which has a sometimes dramatic impact on the returns of your portfolio. So long story short, stable sectors, stable industries, traditional cash flow generating companies are the key focus on credit managers like us. And it's not just about us. Very early on, we switched to healthcare because we thought that was typically the type of things we would do. And as early, it was driven at the time, actually 18 years ago, by one of our LP who was a healthcare foundation, a very famous healthcare foundation in the US. And we turned to healthcare. And well, I have to say that, and I'm not superstitious, so I can tell you that in 20 years, we have never had any single default in healthcare, for instance. What's new for us is the investment in software, for instance, and technology, which is new. And it's been interesting because it's not something we focused on prior to 2010. And it happens to be that not only from a private equity standpoint, there's a strong focus because they sustain very high growth, but also because of their model, subscription model, it's very attractive to credit. which means that the double impact is that multiples have been through the roof for those types of companies, to be honest with you, in the last 5 years. From a credit standpoint, leverage are high, although in our opinion, they are not that high considering their low capex requirements, which is really how we measure the risk when we compare one company to another. That's another topic, but comparing EBITDA multiple for the leverage is not a metric that we use very often. We want to see the real cash flow generation and how much the company can sustain. What I want to say is that healthcare and again, information services are very popular at the moment. The problem also is the fact that there's many subsegments as usual in healthcare. There's nothing, I mean, when you compare a pharma company which manufactures molecules for the pharma industry, or an hospital, clinics, dialysis clinics, general hospital, they have nothing to do with each other except that they are called healthcare companies. In terms of the dynamic, it's still people aging population. And below that, the credit analysis can tend to be very different. And again, my excessive focus on healthcare, for instance, accidents are going to happen again. It's easy to say, well, we're all going to do healthcare and we're all going to do software companies. First of all, there's a matter of supply demand, as usual. And second thing, the headlines may look attractive. Behind the scene might be different because they're all very different companies. And software, for instance, default in the software industry have been pretty low. We expect that to rise in the next coming years.
Okay, Michael, will you agree with this kind of trends that you observe? Like if you look at your portfolio, is there something that you observe in your portfolios?
I mean, let me start also with a few words around sectors. I mean, I'm not a big fan of a pure sector focused approach for basically two reasons. First of all, I mean, there's always some flexibility in sector classification. So taking, for instance, a software company that is producing software for healthcare company, and there is and they are running a second business line that is providing some kind of research in the healthcare space. So is that then software? Is it healthcare? Is it business service? So there's an amount of freedom here. I think what investors should ask themselves is it a more cyclical sector or is it a non-cyclical sector? And if you are doing cash flow lending, then you should definitely prefer a non-cyclical sector. And the second thing you should take into account is obviously, so what is macro drivers behind long term? So will the population age? Is travel becoming a more mainstream product? Is gym chains? Is that some? Will people try to look also attractive when they are approaching a higher age? So this is more the questions people should ask about, and that's why I'm also not angry on people that probably had an allocation in a travel agency in their mid-market lending portfolio, because I mean before COVID was stepping in, I mean everybody would probably agree that the travel business is a long-term growing business. And the second thing people should bear in mind is obviously diversification. So that's something that can help you a lot. So without making here big examples, one could think of having a portfolio with only 15 names and there's issues in 2 or 3, or having 15 names and there is issues in 2 or 3 companies. So that's an easy point that investors can address. So so what's the things then I do see in terms of trends apart from healthcare or technology. What I do see is basically three things that come on vogue. So the first thing is Asian direct lending that is growing in importance. You can also read about private equity secondaries, which can be a nice enhancement for some portfolios. And somewhat related to the technology software space is the theme of venture debt lending and lending on recurring revenues instead of EBITDA underwriting. So I mean, I'm not a big fan of each of them. However, what we have on our focus right now is obviously Asia and Asian direct lending, and I can imagine that this will probably also something we will hear a lot more about in the future.
Okay, thank you, Michael. Before moving to Declan, I know that we have like a poll function. So you will be, for the people that attend this session, you will be able to answer one question using the poll function. Having said, and so you will be able to see it, hopefully from a technological point of view. Moving on to Declan, do you see from where you sit different trends in the private debt that you would like to highlight?
Well, I mean, it's seldom that we would have an investing client ask for a specific sector. But typically what they want to see is a demonstrable track record of a manager actually making good sectoral bets. So they would we would, on their behalf, we would review the performance across, and we would look at diversification across different sectors, and we would hope to see the avoidance of sectors that have massively underperformed. However, we are cognizant of the fact that it is not a liquid strategy. It's not that you can be as nimble as you would like in this strategy. So the key things is we look for track record, and we do look for sensible diversification. I think all the other points in terms of sector have been pretty well covered by Michael and Frédéric.
Okay, thank you, Declan. So let's move to another massive trend, which is the adoption of ESG across the board from regulators, LPs, and GPs. Declan, at the beginning of the introduction, you mentioned that you were very involved in ESG. Perhaps we can start with you. What is your view of the ESG landscape in private debt? Is it something that is important to you and your clients?
Absolutely, hugely important. I mean, I think ESG and a ESG framework for both LPs and GPs is critically important now. I somewhat joked at the beginning in the introduction. I said we follow the Dutch school. And the Dutch school is pretty much pragmatic, and the Nordics have adopted this as well, to say that ESG is somewhat of a journey for GPs and LPs. And what you actually want is you want a sensible ESG framework. You want sensible periodic reporting, either 6 months or 1 year or annual reporting. You can't really do it on a tactical basis. It doesn't make sense to do it on a monthly basis. So that sort of time frame. And the idea and the concept is that over time, you can see iterative steps to form a more perfect ESG framework. Both for investing and for analysis. In terms of our view, whether ESG triggers alpha, we're a bit skeptical on that. However, what we would see is that a sound ESG policy often goes hand in hand with good alpha. So said another way, the good husbandry of scarce resources, it would follow that actually suggests a company is well run and therefore will be able to maintain performance over the longer term. So what on the reporting side, we want the reporting to be clear. We like the fintech applications around dashboards and clear and concise reporting of tangible targets to suggest progress against an ESG journey. In terms of private equity and private equity, it's a little bit more easy to exert control than it is in the private debt side. However, on the private debt side, what we're increasingly seeing, and we review this, is more ESG orientated covenants, and I'm sure Frédéric will talk a little bit about those. And those are kind of binary in some cases, where if you're not adhering or if you don't meet these covenants, you will not be included in the investment portfolio. But it's coming to stay. I think the Nordics and the Dutch were first adopters in Europe. The UK actually has done pretty well from a slow start, and it was mandated, certainly in the public plans. In the US, with new regime in the White House, we're expecting to have more focus on ESG. Asia is a little bit of an outlier. However, China is becoming much more important in how they view ESG, notwithstanding the reliance on fossil fuels. Let me pause there. Pass back to you, Gerald.
Thank you, Declan. Michael, you're also an LP. ESG is ESG important to your process?
It's definitely important, and importance is growing. So, however, I mean, it's important to understand that ESG in context with private debt is not a natural science. So it's rather a spirit, and it's important in which direction things are going. And yeah, so as Declan mentioned, probably private debt is also not front running this theme. However, ESG has also affected the private debt market already, and I think in terms of jurisdiction, so obviously Europe is leading, and so it's much easier than years before starting conversations with European managers about ESG. So there might be sometimes strong differences compared to the US, but in Europe you can talk with external managers about that theme, and there is quite often relatively good standards already in place. So what we are doing is basically, in terms of ESG, is we take the guidance from our group policy, which is obviously also incorporating ESG, and so we are trying to address these things during our manager due diligence. So there will be some couple of questions how ESG is implemented manager wise, and the second step we are doing is obviously we are trying to exclude certain ESG risks contractually. So I think this is a relatively good standard already. However, that will also evolve over time, and at some point in time, so probably you will be at a stage where you are benchmarking managers against each other, or you are trying to benchmark investment guidelines against each other, and then selecting obviously the one that is putting more focus on the ESG side if the rest of your due diligence points is obviously in the same ballpark.
Thank you, Michael. I see the time is flying quite quickly. So, Frédéric, you are the GP in the room. So, how did you manage the ESG journey at NV?
Well, I'll try to be short, and there's a lot of interesting ideas from Declan and Michael about ESG. We started again because we were lucky enough to get some LPs with very strong views on the way that they intended to invest their money on moral grounds and philosophical grounds. That was the case 20 years ago. They said, we don't want to invest in tobacco because it's bad for health, and we're a healthcare foundation, so you won't be able to invest in tobacco-related companies. That started that way. It's been accelerated. We've accelerated that with some requests from other LPs, to be honest with you, And then UN PRI came. We adhered to UN PRI principles. And slowly, until I would say 3 years ago, we had a journey step by step. And then suddenly, 4 years ago, we got a lot of requests from existing LPs, potential LPs, as Declan said, mostly from Nordic investors, asking for some more for some specific pragmatic approach on ESG principle. Again, I don't want to repeat everything that's been said, but we've seen that acceleration, a dramatic acceleration over the last 2 years, with now some LPs, and I have to say, actually, the most stringent ESG questionnaires we've ever received came from a Spanish investor just a couple of weeks ago, and he's by far the most stringent one. And what we are doing at the moment, so Europe, Western Europe, generally speaking, it can be Germany, the Nordic countries, France, Spain, are very well ahead of the US. But as Declan said, I think we expect this to change with the election of Biden and the headlines that have been in the press. Asia, again, not a main focus. So for us, the revolution is the fact that we now have all of our portfolios rated from an ESG standpoint with an external firm called AT Finance. I don't have any conflict of interest here, but AT Finance helps us build those ESG rated portfolios that we give to all of our LPs. I think it's a trend. I think it's very important. We are very happy with that. And just to end up in terms of returns, no, we don't think it adds anything to our returns. But again, I agree with Declan that when you invest in a company which is ESG aware or is doing certain things to address those, it tends to be very well managed companies, generally speaking. The other point is that people that won't adhere to ESG principle will be or are already or will be penalized at some point, and therefore will affect returns, their profitability, and therefore our returns. And that's coming very, very fast. Look at all the chemical companies in China, for instance, where they penalize heavily polluting companies nowadays. It exists already. So it's a one-way street. The requests are going to be exponential, and I think it's a good thing. So the benchmarking, to end up with Michael, already exists for asset managers in the US. So there's already a benchmark for ESG in the US for asset manager. And I agree with Michael, it's probably going to come up soon for private debt managers.
Thank you, Frédéric. As we only have like 1 minute left, so just in a few words, Michael and Declan, do you see the future of private debt as being very positive, negative, average? Who wants to start? Michael, perhaps?
Yes, so I think private debt is here to stay. I mean, we already touched on the things that of bank retrenchment. So and we all know about the amount of dry powder in the private equity space. So somebody has to top these companies, and I think it's a nice concept to match that with long term in or the equity portion with long term financings provided by long term investors.
Declan?
Yes, I would agree with that. It's an asset class that's here to stay. You will see a permanent allocation across all different investor types into this asset class. Very much so.
The last word for you, Frédéric. What would be your view of the future of private debt?
It's a bright one. Again, I think it's just not so serving. I truly believe it found a specific way to get here for the long term. I think we addressed we address something that the banks don't address anymore. I think the transformation is going to continue, by the way, with some lending platform. I've seen some corporate lending platform actually coming up, which got some very, very interesting development.
Okay. Thank you very much. I think we are running out of time. But one thing is about the poll, like the question we ask, it seems that 85% of the people agree with you that the shift of the financing will go away from banks and it will help the private debt landscape. So again, Frédéric, Declan, Michael, thank you very much for joining us today and all to join this panel. And I wish you a great day, afternoon, evening, depending on where you are.
Thank you very much.
Thank you.
Thank you. Bye.
Take care. Bye. Bye.